What's your take on India's key macro variables which have been impacted by the crude price shock?
Sure. So, this is interesting, Sonal, because in the past, if I were to, let's say, particularly refer to, let's say 2013, the shock to the Indian system in terms of macro was coming from one, high inflation. Secondly, it was coming from pressures as far as the trade deficit was concerned, right? Trade deficit, and of course, it gets adjusted by a current account deficit being smaller because of a surplus on the services side. But those are the two pressure points. We already talked about inflation. That is certainly not a pressure point like it was in 2013. In 2013, inflation was double digit. However, this time the pain for the Indian currency is coming from the capital account, not on account of trade. So, what is trade account? Capital account? Capital account is nothing but the capital inflows into the country. These could be FDI, these could be FPI inflows, these could be repatriation of FDI, which is outflow. It could be outbound FDI, which means Indian companies making investments overseas. So it is this capital account which has created a issue for India, because in the past we always had a current account deficit, but we could finance that deficit with the surplus on the capital account. Now, in recent years, as you all know, one big challenge for India has been foreigners have been net sellers in India. So if you look at the last 3 years, the net selling by foreigners in India comes to almost $43 billion dollars of selling by foreigners in India. And if you look at the last 6 years, including current year to date, in 5 out of the 6 years, foreigners have actually been net sellers in India. So this has been a challenge in terms of the source of capital coming into India, FPI going negative. But it's not just FPI going negative. On the right side chart, we have actually broken down the total change in the capital account between the period 2024 and 2026. So in 2024, the capital account had a $89 billion balance. However, if you look at the period since then, we have total outflows of $46 billion dollars from FPI. Then we have outflows on account of FPI debt, which is about $17 billion dollars. Then we have FDI repatriation, which is money going back from foreigners. That's also negative. Miscellaneous is also negative. And then we have some net positive flows coming through on ECB and FDI. But net from $89 billion, dollars, you are seeing the sharp fall of almost $60 billion dollars down to minus $24 billion dollars. So it is this fall in the capital flows which is now creating a funding shortfall to meet the current account deficit, and this is a big source of pressure on the Indian currency. If we move on to the next slide, uh, you know this is looking at another aspect that, because crude oil prices have gone up, and because India has the oil marketing companies, we have not passed on the full impact of the crude oil prices to consumers. So what does that mean? It means that it is the government, either directly or through the oil marketing companies, which is absorbing the hit that the economy should be facing on account of the higher crude oil prices. How much is the hit that the government is taking on account of the fiscal loss? Remember, they made an excise duty cut. They have had to increase the LPG subsidy. B, because the OMCs are now making negative margins, the dividend that they receive from these OMCs is also likely to come down. So, if you take all of this together, the total hit to the government is almost 1.6 lakh crores or 1.5 trillion rupees. The other challenge with the higher prices right now, particularly of the whole crude oil and gas complex, is, remember, these are the fuels which go into fertilizer production, particularly urea. So, as far as urea and fertilizer in general is concerned, the additional liability that Government of India will have to bear, because we continue to sell fertilizer at the same price, is 1 lakh crore or 1 trillion rupees. So there's almost a 2.6 trillion rupee hit which is coming from our policy of holding back the negative impact of fuel prices on consumers and businesses. However, there is also a positive impact which is coming through to the fiscal. One is the Economic Stabilization Fund, where they are getting the benefit of some revenues on account of taxes on fuel. Secondly, they are likely to make some cuts to capex and revenue. Finally, we are presuming that there will be no significant change in the RBI dividend, though I'll talk more about that later. So, if you account for all of that, they have a net benefit of potentially 1.8 trillion rupees. So, the net fiscal slippage comes down to only 800 billion rupees, which is about 20% of 0.2% of GDP. This is not a number which can really, throw the economy completely out of shape, because 0.2% is a small number. Eventually, we may not even resist, we may not even get to that number depending on which way fuel prices behave. They could even go higher. But I'm just saying at 20 basis points, it doesn't destabilize the economy very significantly. Another way of looking at this, or other another metric we need to look at, is on the next slide, Sonal, which really looks at what will be the impact of the current account and the balance of payment if crude oil prices remain elevated. So in 2026, the estimate was that the current account deficit would be at 0.9%, and the total current account, the balance of payments would also be at 0.9%, because net capital would be sort of neutral. Actually, the fourth quarter current account balance came in slightly better than expected. So I think instead of 0.9%, this number might look more like 0.6%. That's a minus number, 0.6%. So in a sense, this has come in slightly better on the correct number, on the reported numbers. But if crude oil prices were to remain at $90 a barrel, $100 a barrel, and $110 a barrel, then this is what the impact would look like in terms of the current account deficit. Anywhere between 2% to 3% would be the current account deficit, which is obviously significantly higher than the 0.6% that we had in 2025 and 26. And remember, RBI's comfort level is about 2% of current account deficit. Now, let's go to the next slide, because I think very, in a proactive manner, what RBI did in its return monetary policy. I know there are lots of stuff here. You can read it later, but I will essentially say that there are two tactical measures that they have taken, which will significantly drive in capital into India. One is the concessional swap facility for PSUs. Second is the FCNRB scheme for depositors. These two measures are very similar to what was done in 2013. If anything, these two measures this time are even slightly more liberal than what was done in 2013. Broker estimates, Citigroup, Jefferies, whoever you look at, is that in 2013, these two schemes raised almost $34 billion. About $26 billion was raised through the FCNR scheme. $8 billion was raised through the ECB route. This time, people are talking about broker estimates $50 to $60 billion. As I said, depending on which broker estimate, economist estimate you look at, could come in from this route as far as capital inflows are concerned. So this will significantly plug the deficit that we are worried about, because remember, if you're talking about a current account deficit of 2.5%, let's say, that's roughly about $100 billion. If you get almost $70 billion from these two schemes, and then you get some more capital from elsewhere, you could go back to a situation where your capital account balance is back in positive territory, or at least neutral territory, or certainly not a number that we would need to worry about. So I think these above measures to attract fresh inflows and drive one-time capital flow boost is a big positive. It's a good tactical response. RBI is doing exactly what it did in 2013, so it should stop the panic. On a longer term basis, I would say these are two more interesting things that the RBI has done. It has enhanced the scope of government securities that foreigners can buy. Secondly, it has made government securities free of capital gains and withholding tax for foreigners. This has been the consistent demand from foreigners, that they don't pay this tax in other geographies. And I think just doing this change should allow India to increase its weightage in some of the global bond indices. That can result in structurally positive flows. So I'm not even getting into what can come in terms of structurally positive flows from foreigners on a regular basis because of these two liberalizations. Just the two tactical measures that they have taken should allow this year about 60 to 70 billion is the current estimate. So I think these targeted measures should certainly boost capital inflows into India, and that is very good news. Moving on, I think, yeah, one final point over here. This is India's real effective exchange rate. 100 is the baseline. When the rupee is above 100, it means that the rupee is overvalued, right? So this is the territory in which the rupee is overvalued, correct? And when the rupee is below 100, this territory, this is where we would say that the rupee is undervalued, right? So when the rupee is right now here at this level, remember it's just slightly above where it was in 2013 period. It is now at the depths of where you would consider it to be undervalued. So to my mind, we can talk about what the rupee will do in the next 6 months, 12 months, 18 months. But I always say that starting valuations have a disproportionate impact on outcomes, not news flow. From that point of view, I would believe that this starting point should actually create a good outcome in terms of the behavior of the rupee from here over the next few years.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.